One. Hi, everyone. This is Gary Wilson, and welcome to this week's live Path to Prosperity webinar. Welcome aboard, all of you, no matter what program you're in. Most likely, you're in the Investor Agent Training Program, although we do have some folks in property management and also some folks actively in the buying rentals, rental profits without the pain. I don't think there's any active flipping students right now. I could be wrong, but and I don't think there's any active wholesaling students. So in any case, welcome aboard. If you notice, you're by default in mute mode, and of course we can't be all live verbal at the same time, so you can use the chat box to type in your questions. Also, if you could please remember to always get the email the next day from Beverly. She often gives you updates, scheduling updates, system updates, so forth and so on. So I don't have a definitive date yet on the new LMS, which means Learning Management System. They are switching out of Digital Chalk and into another platform. And what they'll do is they'll test it, and any new students coming on board, once it's completed the testing, will be in the new system. And if you're in the old system, you'll be grandfathered in. If you do decide to continue once your year's up or you do another program, at that point, you'll likely be on a new platform. Shouldn't be much different. They're all a lot alike. Well, this one has some additional bells and features that are kind of neat. So in any case, that's pretty much it. I'm trying to think. For those of you who don't know, for me, I'm going to be here in Texas all the way through the end of October. And I've got Louisiana in November and Arizona in December. And then after that, in January, we start in Florida. So I'll be in Florida January, February, March. But in case for right now, I'll be in Texas pretty much for the next month and a half. I got 1 week off in October, which, by the way, that is the week of October 14th. That week I will be off. We'll likely have some time slots available for student calls. I'm just basically taking a week from teaching. My voice is giving me some fits lately here. So in any case, I need teachers. Some of you hopefully raise your hand, type in the chat box if you want to be a teacher, okay? Because we could sure use them. In any case, without further ado, let's go ahead and jump into tonight's subject, creative purchasing techniques. What I'm going to do is I'm going to give you some ideas of, and by the way, if you don't already have this, this is from the 6th book. A lot of you probably have this if you came to one of the 3-day events. But in any case, I'll have Beverly send this out in the email tomorrow with the recording of this webinar. So you'll have, it's about 100 pages. It's like 30 different creative purchasing techniques, okay? What I want to do is kind of point out the ones that make the most sense for someone who's just starting to build a portfolio or just starting out flipping or buying rentals or investing in general, because maybe they lack capital or they lack credit or some combination thereof, okay? And then the other ones, I'll highlight the ones that make the most sense for using once you already have assets, okay? Particularly with equity and some cash flow. All right, so I don't want to give you all the details in the background, but creative investing techniques are not new. In fact, a lot of the ones I learned from some of the gurus back in the 80s, and I found out that a lot of their ideas I got from gurus back in the 50s, okay? So, and actually we have evidence of creative purchasing techniques going all the way back to, BC, before Christ, so more than 2,000 years ago. It goes back quite a long time. Traditional banking has been in for several hundred years in the United States. At the turn of the early 1900s, in fact, 1913 was when the Federal Reserve was created, and that created the modern American banking system. But in a lot of European countries, they had banks that have been there for several hundred years, okay? So in any case, let's just talk about some of the sources for creative finance and creative purchasing techniques. The seller is obviously a source. The property itself is a source. Other investors or partners, tenants can be a source, believe it or not. Agents and brokers like us can also be a source. Most of us are licensed here. Obviously, you can offer your services and skills, which technically you can offer your commission if you're an agent. The existing loans on a property can be leveraged in a transaction. You can also have unsecured paper notes, IOUs, loans, things like that. And of course, last but not least, traditional banks or what we call institutional lenders. So in any case, let's jump into some of the ones that maybe would work great early on. So here's one, first one, pledged asset mortgage. So let's say you're an investor or you have an investor who wants to start investing and they just don't have enough cash and or credit to get started, but they have other assets. They have boats, jewelry, paintings, cars, coin collections, stamp collections, all kinds of things. You know, CDs, bank certificates of deposit, which are very popular right now. Maybe they have retirement funds that they couldn't otherwise borrow against. Okay, so in other words, they might have retirement assets that are structured in such a way that the federal government doesn't allow the owners of that asset to borrow against that retirement fund, unlike a self-directed IRA or a 401k that you can borrow against. Okay, so in any case, retirement funds, life insurance policies, all kinds of assets you can use in collateral or leverage when purchasing real estate. So what that looks like is this. Let's just take a really simple example of a CD. Believe it or not, when I first got into banking and real estate investing, we still had CDs paying 15% from back in the late 70s and early 80s, okay? And they were a hot commodity because as interest rates with deregulation setting in and interest rates dropping throughout the decade of the 80s, if you imagine if, let's say, interest rates were prevailing at 8% and you had a CD that was paying you 15%, as you might imagine, you could have sold that CD for a lot of profit. You know, let's say you bought a $100,000 CD and it's paying 15% when all of those CDs are paying 8%, your CD is a whole lot more valuable. So you can sell it for a premium because the buyer would then receive that 15% interest. You receive a massive payout. Okay, so let's just use as an example. Right now, CDs, I've seen a few that are paying, 3 and 4%, very, very rarely. Okay, most of them are around 1 to 2%. In any case, what you could do is you could pledge that asset. In other words, instead of cashing it in, you could go to a lender, sometimes let's just say a private lender, okay, not a traditional bank, but a private citizen like you and I, and say, look, I've got this CD. I don't want to cash it in, but I'm willing to allow you to write up a lien to be recorded against that CD should I default on the loan that I'm going to be asking you to make me, right? So you ask them to make a loan to you for something equal to or less than the face value of the CD, all right? And then you basically give them a mortgage, they give you the note, okay, and you secure the property with that. In a certain period of time, you would perhaps refinance the property and then pay back the person who loaned you the money. All the while, your CD is left intact, although it is at risk should you default on the loan to the lender. Okay, so in the case of a default, you have what's called a confession of judgment. You have to sign that. The lender, in most cases, will never lend you money on a pledged asset without you signing a pre-confession of judgment. So if you default on the loan from the lender to you, the borrower, they could go and attach or seize your CD. Okay, so that's just one example. Let's say you have a note. In other words, you have a note that you gave somebody who borrowed money from you. Let's say you loaned $100,000, and in return you've got a note, okay, representing that $100,000 loan, and it's receiving interest. Well, just like a CD, that note can also be sold or leveraged. Remember, anything that can be considered a commodity, particularly if it produces income, can be bought and sold. In fact, a lot of people don't know this, but certain leases, like triple net leases, can also be bought and sold because they produce an income, okay? And they can be bought and sold just like notes. So the point here is, I'm sure you're gathering the basic theme here is that you're pledging an existing asset that you do have. It's probably not real estate in this case, and you're able to borrow money from someone by pledging the asset and allowing you to go out and buy an income producing asset, i.e. a piece of real estate. So now if you're not investing and you're simply acting as an agent, you should definitely share these techniques with your clients, okay? If they have any questions, get them on a conference call with me, okay? I don't mind walking through these with them. But pledged asset mortgage, is a great way for people to get into the business who are unable to get traditional financing, but they don't want to wait. They want to get into the real estate business now and get started investing, generate passive income, flip homes, whatever it is they're doing, okay? So that's one strategy, pledged asset mortgage. By the way, any questions on that? If you have any other questions on that, just please type them in and let me know. Let's see, let's go to by the way, here's one that would make sense if you already have real estate. It's called a blanket mortgage, and this was one I used extensively and still do today, by the way. So for example, let's say I have 3 properties, they're all duplexes, and they're producing an income, respectable income. And over the last 3 to 5 years, they've grown in equity. So they're now worth more money, have a greater equity position because I've been paying on the mortgage and the values have gone up over time. They've been appreciating over time, all right? So the way this works is you can find a lender. In most cases, it's going to be a private lender, although there are commercial lenders who will make this loan. They'll give you what's called a blanket mortgage, and that mortgage blankets the existing properties that you already own. Now, the way this would generally work is if, let's say you had the 3 properties, across the 3 properties, you owned more than 50% of the value of those 3 properties. In other words, what you owed was less than 50%. And the reason this is important is lenders who would make this type of a loan, they see that they're going to be in second position because you're not refinancing your properties in this example. You're keeping the original loans because you've amortized them. You don't want to start all over again with the amortization. You want to benefit. You've basically built more equity, and your mortgage payment is now more principal and less interest at this point. Okay, but here's what I'm getting at. In a lot of cases, a lender will let you do that loan, but in some cases, they only will lend you up to 50% loan to value. So what that means is, if you owed more than 50% on the existing properties, this mortgage would not work for you in most cases. You'd have to, wait till you had greater than 50% equity to be able to get a loan, which are in a lot of cases 50% loan to value in the example of a blanket mortgage, okay? Now, having said that, there actually are lenders who will give you a blanket mortgage up to 70% loan to value. We have one right now. One of my students in Virginia Beach, Dan Levy, is a mastermind student, is actually doing it as we speak, and the bank's already told them they want to do more loans with him, okay? So what that means is he can now borrow against the equity in his existing investment properties to go out and buy the next property. In a lot of cases, you would just use it as a down payment, maybe put down 20%, and then you get a traditional mortgage for the other 80%, okay? But the point is that blanket mortgage gives you access to equity in your investment properties to buy more investment properties. So this is not a traditional home equity line of credit. That's not what we're referring to, although it is a technique you can use, okay? Which we'll talk about later. So in any case, the beautiful thing about this is, let's say you do buy the new property and it's a value add. What that means is you improve the value, you raise the rents, make it more profitable and more value, have more equity in the property, you build up it appreciates in value because of the efforts you put into the property. You make it twice as valuable in the next year. You can go out, get a brand new first mortgage on that, but only 50% loan to value, enough to pay back your line of credit, okay? Which does this. When you pay back a line of credit early and you add an income producing asset to your portfolio, in most cases, that lender who gave you the blanket mortgage, the commercial line of credit, in other words, will extend the line of credit and increase the line. They'll add to the line proportionate with the new income producing asset you just added to your portfolio. Okay, this is a great strategy once you're up and running in production and you do want to tap into your equity and not refinance, okay? It allows you to keep growing, and quite frankly, once you master this, it's almost like a curve, allows you to grow exponentially over time, okay? So blanket mortgage, awesome strategy. I use it a lot. One of my favorite techniques. I didn't use it for quite some time because early on, I didn't have the equity position I needed to be able to do that. Okay, so blanket mortgage, that's one you use for once you have assets. Here's another one you can use in almost any scenario, but typically they're for people who are just starting off in a transaction or starting off investing. You can leverage the broker's commission on a deal. So I've had this done before as a broker, right? And I'll be the first to tell you, I didn't like it at first. I didn't like the scenario, but here's what happened. The buyer ended up, collectively what happened is I ended up collecting 20% in aggregate on the deal. Both buyer and seller kicked in to pay me 20% commission on that transaction. That 20% commission on the transaction ended up coming in the form of me having ownership of that property. In other words, I leveraged, I gave up my commission, my right to commission, to gain 20% of the deal. And believe me, it was worth it, okay? I mean, let's face it, on average, we're getting 6% across the board. That's both, we get both sides, the buyer side and the listing side, which means we're typically only getting 3% on one side. But in this scenario, I brought the two parties together. They couldn't really come to terms like I was hoping they would. And I got asked to take a cut in my commission. And so I'm not interested in making a cut in my commission. That's not how I do my business. However, I'm willing to be a partner. And through negotiating and structuring the deal, I ended up getting 20%, guys. That was my cut for it, because I found the property, found the buyer, figured out how to creatively get the deal to go through with the bank. I mean, and by the way, I got the management contract too on that one. So I even got 9% management fee, plus fees on leasing, application fees, lease renewal fees, all those fees I got. And I got the owners additional income too, because I implemented, pet policy, smokers policy, a nuisance call policy, things like that, and, where the owner got some additional income too, or the new owner, excuse me. So in any case, using the broker's commission, don't be shy about this, guys. Always check with your owner of record or your broker of record. In most cases, they will let you get away with that, especially if it meant the deal was going to go through, okay? So using broker's commission is a great strategy you can use. Typically, that's for people who are just getting started. They don't have a lot of capital, but I've seen veteran investors use that technique too. Okay. Buy low, refinance high. That sounds kind of obvious. It's typically referred to as the BRRRR method: buy, remodel, rent out, refinance. BRRR. Buy, remodel, rent it out, refinance. BRRR. So in this case, whether it's a rental or just a buy and property or like a single family home, you're typically buying low, you're going to improve the value, and then you refinance high. And we did that all day long during the early to mid 2000s, okay? We probably did dozens and dozens of those that way. The bankers are more flexible in those years. Of course, we saw what happened as a result of that. But I see a lot of newer investors start off this way when they don't have a lot to start with. So they look for basically the junker properties, okay? And they fix them up, rent them out, and then refinance once the property's rented out with a brand new first mortgage, paying back whatever money they borrowed to buy the property to begin with, or replenishing their capital if that's what they used. So again, typically a new or newer investor technique, but again, plenty of veterans do the same technique, all right? Okay, here's another one. Create a note and sell it for cash. Great strategy when the interest rate market is changing, okay? So let's say interest rates now are low, right? Let's face it, you can get a mortgage for 3.5% in most cases in the US, and even less in Canada, by the way, okay? But let's say someone wants to buy your property, or in the case of your client wants to sell and somebody wants to buy it, but they don't have a lot of cash. They want the owner to finance. What you can do is create the note representing the debt and make it a higher interest rate than what the prevailing interest rates are, okay? In other words, let's say prevailing interest rates are 4% and you get 8% on this note. What you can do then is sell that note on the open market, okay? And you can sell it at a premium because, let's face it, 8% is better than the prevailing rate of 4%. So somebody would pay you to garnish that 8% return because they're not getting it elsewhere. And you as the seller of the note, can sell that note at a premium, in other words, higher than face value, because the interest rate is greater than the prevailing interest rate. So in other words, let's say you sold your property and you have a note from the buyer to you for $100,000 at 8%, okay? And everybody knows that 8% is a good interest rate right now. So you advertise that for sale, okay, and you can maybe sell that for $110,000, $120,000, sell the note for $10,000 or $20,000 more than what the face value of the note is, because the buyer is not going to be getting 4%, the buyer is going to be getting 8%. And that the future value of that cash flow, that interest rate, is worth something that's worth something to you right now in a part of a sale. So great way to get a property sold, great way to buy a property. Heck, if you're getting private money, 8% is not bad, way better than hard money. Okay, so all the way around, you can see how a newbie can buy a property with a strategy, and a seasoned veteran can sell the property at a steep, get a note and sell that for even more profit than they would have just by cashing in and selling the note. Pretty awesome strategy, huh? Okay, let's move on here. We still got a lot to cover, guys, so hang on to your seats. Okay, deferring a portion of the purchase price. This is a great technique when we're at or near the peak of a market, okay? So right now, people would love to buy a home, but in some parts of the US and Canada, it's extremely expensive, like Toronto and Vancouver in Canada, San Francisco, New York City, are some extremely expensive places to buy, and yet people do want to buy. So one of the things that they can do is defer a portion of the purchase price, okay? You can defer it 1 year, 2 years, 3 years, 5 years, and what you're banking on is that, over time you'll be making more salary. Maybe you're going to rent the place out and you fix it up and raise the rent so it's more valuable later, and you can refinance it when it's more valuable and pay off the deferred portion of the purchase price, okay? So just a unique way to allow someone to buy a property today without going broke and defer a portion of the purchase price to a future date where you're likely going to refinance. Let's say you're back to the market. Let's say you're in a escalating market. You're coming out of a shift, and you know the property is going to be worth more down the road, and you want to buy as much house as you can possibly buy. Where you can buy with deferring a portion of the purchase price to a future date, where the property should likely be worth more in an escalating market. And again, same thing, you refinance or just pull out a home equity line of credit, okay? Then you can pay back the portion that you deferred. So usually, again, this is a beginner's strategy. Typically, someone just trying to get into the business. On buying rental properties, the security deposits, the rent credits, real estate tax credits can all be, are all negotiable, can all be brought over to the seller side and used in the form of credits on a purchase, okay? Just another way to get yourself in the game or get your clients in the game, okay? Let's see here. There's a lot of government loans, FHA 203B. This is one you would do. Let's say you're an investor and you're just getting started. You really don't have much to work with at all. You can buy a duplex and basically fix it up, make it more valuable. You can buy a single-family home this way too, but it's really anything from 1 to 4 units, okay? And what the assumption is the property has deferred maintenance, and you need to remodel it, improve it, renovate it to make it in marketable living condition. Well, FHA will let you get a loan to do that. You purchase the property, you get draws, you take draws to do the construction, and FHA sends an inspector out to check out the progress of the project. Real good way to break into the business, and you live in one of the units, of course, and there's time frames. You have to stay there for a certain period of time, okay, before you can move out or sell or rent out the other unit in case of a duplex. But for people who are wanting their own home and also break into investing, this is a great way to get started. 203B. Lots of other government programs, by the way. Okay, we all know what this is. Good old-fashioned home equity line of credit, okay? With this one, you are borrowing against the equity in your own home that you live in. So a lot of people see that as a risky move. And I know when I first did it, it felt risky, okay? But it worked out great. I ended up doing it over and over again. I ended up getting a line of credit against my property. It was a home equity line of credit. So instead of getting a fixed rate and term mortgage, I did a home equity line of credit that allowed me to borrow and pay it back, and borrow and pay it back, and borrow it, pay it back over and over and over again, okay? Same thing with that blanket mortgage I described earlier that was based on investment properties. It was a commercial line of credit called a blanket mortgage, and that's what I did. I used it, paid it down, reused it, paid it down over and over and over and over again, okay? Now here's something called a land contract. And you can do this in most states and provinces. In some states, they don't allow you. I'm not aware of any provinces in Canada that don't allow us to do this. But essentially what you're doing is let's say you're the buyer and you want to buy a property, and the seller, has some debt and has some equity, maybe they're 50% leverage, and they're willing to get paid out over time. You can offer them getting engaged in what's called a land contract. And what happens is you, the buyer, don't actually get title to the property right away. What happens is you take over some of the ownership rights, okay? But the reality is you're paying the seller a monthly payment, just call it a mortgage, okay, which is what it is. But the seller still has title to the property, legal title to the property, which means they're still paying on their mortgage. Well, the reality is maybe their mortgage is only $1,000 a month, and what you're offering to pay them ends up being $2,000 a month, which is a good deal for you, and for them, they get $1,000 a month passive cash flow without having to do anything, right? By letting you enter into what's called a land contract. And at a future date, at some point in the future, the title to the property would transfer to you, the buyer, typically after a certain number of payments or a certain time frame, or a certain dollar amount has been paid to the seller. There's some guideline that tells you when that title will transfer to you, the buyer, okay? Now, what I would do is this, and this is all written in here, you guys will all get this. If I was buying a property on a land contract, I would have the seller execute what's called a quit claim deed, because if something happens to them later, before title is transferred to me, let's say they become incapacitated, maybe they die, maybe they go through a divorce, and you're not going to be able to get clean title on the property, or if something goes south with the deal, you can take that quit claim deed and have it recorded right away, okay? So it's typically held in a third-party escrow. In other words, an attorney would hold that quit claim deed in escrow on behalf of you and the seller. And if certain circumstances transpire, by default, that attorney will record a deed, okay, which protects you. Okay, so obviously, to the seller, some of the risks are you don't follow through with your purchase, but at the same time, they've kept the title, so there's really no big skin off of their back. Another thing could happen is let's say you go through this process and somehow their bank finds out that they have sold the property, like legally speaking, sold the property. They could call in the note, okay? And if the seller can't come up with a balance on the note, or they come to you for it and you can't come up with it, the bank could come in and seize the property, okay? That doesn't happen a lot, but it is possible to happen. In some cases, the bank will, if they recognize you've been paying payments for more than a year to the seller, you can document that, and you've been living there for more than a year. A lot of times the lender, even though it violates their loan agreement, they would go ahead and just let you stay in the property and, hey, get your remortgage, okay? So it's not the end of the world. It does happen, but banks often are interested. They're in the business of making money, and typically by lending money out and receiving the amortized payments, okay? But in any case, there are risks with this strategy on both sides, but it does allow you, the buyer and the seller, to enter into an agreement that's equitable for both parties. The benefits of the seller are you're living there like it's your own because you're going to essentially receive title to it. So you take care of everything. The seller doesn't have to take care of everything. They're getting a monthly payment from you that exceeds their mortgage payment, so they're getting positive cash flow for doing nothing. And you, at the end of the day, you get a property you wouldn't otherwise been able to purchase, okay? So land contracts, a lot more complicated than that. I just want to give you the basic gist there. Insurance policy, okay? Life insurance policy loan. A couple of ways to skin this cat, but in most cases, what you're doing is either you have a whole life insurance policy on yourself, or you have a family member or loved one who has a whole life insurance policy, and they don't mind you borrowing against the cash value of the policy. So let me explain this. So let's say, again, you want to get into real estate investing. You don't have a lot of cash, you don't have a lot of credit, but you or your spouse or a parent has a substantial whole life policy with a lot of cash value built up. Okay, in a lot of cases, the life insurance provider will let you take that cash value out and use it, but they won't let you put it back in. Okay, once you take that money out, you're basically taking it out. Now, on the other hand, you can borrow against the cash value portion of that life insurance policy. Let's say you got $1 million life insurance policy and you got a cash value of $100,000. You can get a loan. We talked about this before, a pledged asset mortgage. In this case, the asset is the cash balance value of the life insurance policy. Borrow against that, so you don't take the money out, you just borrow against the value of it, which leaves the money in there for the person who has the policy. And allows you to borrow against that and go buy yourself a property. To give the life insurance policy holder some collateral or some risk reduction or liability protection, you can write up a quitclaim deed so that if something happens to you, the deed of the property goes to them, so they get the property, okay? You could also, let's say they're concerned because they've got children and a spouse to care for, in case to look out for in case they die. You could take out a term life insurance, which is a lot less expensive than a whole life policy. Take out a term policy on the whole life policy holder. So if something happens to them while the loan is out, you can pay them off. Okay, you can pay them off with a term life policy. You name you as they're insured and you're the payee. So you would get the proceeds, pay off the loan to the person who passed away, so that their heirs get the loan proceeds and the original life insurance policy cash value. I probably got way off the deep end there as far as complexity. I just want to show you easy thing to do and lots of ways to build in risk reduction and liability protection. Okay. Okay, a whole life insurance policy. All right, lower the price, raise the interest rate. So here's some things you could do when prices are really high and interest rates are low, almost like what we have right now in today's market. I mean, there's markets I've seen, guys, that have just literally doubled in the last couple of years. The values have just gone up and up and up and up and up. In fact, where I live part-time in London, Ontario, spring of 2017, the average list price was $267. Right as of this summer, the average list price is nearly $450,000. It's literally almost doubled just in the last years. It's crazy. So what can you do? Well, here's something you can do. We know interest rates are low to traditional bank financing in the US and Canada. What you could do is you could approach the seller and say, look, I want to buy your house. I can't afford it the way it is. I mean, it's just way too expensive, but I think we can strike a deal. If you own or finance me, what I'll do is I'll give you a much better rate than what the banks are paying, okay? And you make sure it's a payment you can actually afford, but you lower the price. And the reason you do that is eventually in a year's time, you may want to go out and then refinance the property under your name, okay, with a traditional mortgage that pays back the other person that you bought from and who financed you. So for example, let's say you got a $500,000 property, you could buy it for say $400,000, but instead of the seller not getting anything other than the 500,000, you offer them an interest rate that's twice what the prevailing rate is, say 8% versus 4%. Next year, the property is going to be worth even more. You could go to a lender and say, look, I own this property. I've owned it more than a year. It's been seasoned. I only bought it for 400,000. Would you refinance it at 500,000, which is really is what it was worth last year, but it's worth now 550 now. Give me the 400,000 to pay back the old owner. So you pay back the old owner, and in the year that they had the loan out, they were making 8%, not a bad deal. But guess what else they could do? They could have gone and sold that note, okay, and turned a profit. And then whoever bought the note would get paid off when you got the new mortgage on this property. Great strategy when prices are high and rates are low, okay? Move a private mortgage from a senior to a junior position. This is if this is a unique circumstance where if the current owner has a private mortgage on a property, okay, and they're in first position, what you can do is have them go to a bank, get a brand new first mortgage on the property, a traditional mortgage, moving their private mortgage to second position, okay? And then the first mortgage lender now has a premium position or in first position. In any case, so it's not very common. The reason why this might happen is, let's say the property is teetering on the edge. The private mortgage lender is fearful that the property is going to fall through and they don't want to foreclose and all this kind of stuff. And they'd be willing to take a second position with a payoff or a payout, assuring that whoever's going to buy the property is much more qualified than the person who's selling. So even though they get second position, they maybe get a kicker or a premium when a property eventually does sell traditionally, or they get something else in lieu of that. So you've got to pay them for taking a second position is what I'm saying. But sometimes that's what it takes. Sometimes a person wants to buy a property. Here's another example. And they go to a bank and the bank's like, well, there's a mortgage on the property. It's a private mortgage. They're in first position. We don't want to be in second position. So if that's the case, if they say, we'll give you the mortgage if we're in first position, then you can go back to the other person and say, look, I can buy the property, but your private mortgage has got to be in second position versus first position. Another example of how you can use that. Okay, let's see here. Attend a new mortgage, pay off existing loans, and provide down payment money. Let me check just got a question that came in here. Let's see, Helen. Hi, Helen. What happens in the land contract strategy if the seller fails to make their mortgage payments? Well, that's a risk to the buyer, Helen. So in other words, let's say you, the buyer, are making payments to the seller, and yet the seller is not making payments to the bank, okay? The bank could eventually come in and file what's called notice of default. They do that 3 times. They could start the foreclosure proceedings, which is about average across the U.S. and Canada. So in the case of the buyer, if they can show that they've been paying on the property for more than a year and it's documented, and they have taken essentially ownership of the property, they just don't have title for it. A lot of cases, the bank who has the original mortgage doesn't want to foreclose. It's a pain in the neck and it's expensive, and nobody wins. They kick the old person out, and then nobody's living there, cutting the grass and shoveling snow and paying the bills. So a lot of times the bank is going to be willing to negotiate in a situation. Another thing is, remember we talked about executing a quit claim deed when you're the buyer, do it using a land contract. So as soon as you determine that the seller has not been making their mortgage payments, you could then record the quit claim deed, which gives you legal title to the property. And then you can negotiate directly with the bank and say, look, that person doesn't own the property anymore. I own the property now. Okay, I've been paying them, but you've been living here a year. If you'd like to continue, with the loan, let's move the loan in my name, and then you stop paying the old owner. Okay, so it's not like it's a dead end situation. You just you got to keep your head about you. But that's an example of what would likely happen. Two scenarios of what could potentially happen. Good question, by the way. Thank you. Okay, obtain a new mortgage, pay off existing loans, and provide a down payment. This is kind of a unique strategy that involves you've got the old owner has to typically have some equity in the property, but not like a majority equity stake. What you can do is you can get a new mortgage on the property that's enough to pay off the old existing mortgage and any other loans for that matter, and still have enough left over to give the seller whatever down payment they want. And then you can still do a private mortgage for the remainder. And I've actually done this before. So in other words, there was really a total of 3 loans involved. In fact, let me explain it to you. So a little bit of a unique twist on what we just did here. So this was years ago. I had a property I was able to purchase. It had a VA mortgage on it. And by the way, VA mortgages are still assumable, okay? And also, a lot of variable rate mortgages are also assumable, okay? A lot of people don't realize that, but a lot of variable rate mortgages are definitely assumable. In any case, in this scenario, what we did is I assumed the seller's first mortgage, which was a VA mortgage. He had a second mortgage on the property. And what I did is I refinanced that second mortgage with a brand new second mortgage, giving him, paying off the second mortgage, and the remainder was enough to give him some extra cash. Okay, he got money in his pocket. The remainder, my second was more than his second. He got the difference in the form of cash. That was essentially my down payment. And he still had equity, so I gave him a third mortgage for the remainder of his equity. It was about $17,000 as I recall. And that got paid off in a balloon 2 years later, okay? In any case, unique strategy, but what I'm getting at is you can get a loan against the property to structure the deal so that the existing loans are paid off, and then the remaining balance goes to the seller in the form of a down payment, and you still have the remaining equity figured out between you. It could be, again, private mortgage like what I did. Real great strategy. Okay, I think we're getting close to the end. There's like 30 different techniques, but I'm going to go over, I think, about 20 of them, if I'm not mistaken. Okay, here's something really neat. This is an advanced strategy, rental participation. This is the kind of thing you can use if you're buying a larger building, okay? 10 units, 20 units, 30 units, you name it. The last time we did this, it was a 30-unit building, all right? Here's what we did. The seller had inherited the property. He was an heir. The property was owned free and clear, okay? But he also was not managing correctly. They had a 30% vacancy rate, 30%, okay? So what we agreed to do is I said, he wanted like whatever, $1 million for this property. And of course, on paper, it wasn't worth, it was probably worth half of that. But lo and behold, he's like, no, this place is worth it. He didn't know anything about real estate. He assumed because his parents said it was worth $1 million, he assumed it was worth $1 million. But on income producing properties, the value is based on the income it produces. And it was only producing 2/3 of what it should produce. So no lender would look at that and make a loan against it as if it was fully occupied, because it wasn't. So what we agreed to do is this. I said, look, I'm not going to give you your price right now. What I'll do is I'll give you a price that works for me based on its current performance, okay? You're going to take a big discount on the purchase here on you selling the property to me on my purchase of your property. However, if the property really does perform well, I should be able to raise rents. So what I did was discounting the vacancies on all the existing rented units, the other 70% that were rented. What I said was, as I raise the rents on those properties for the next 10 years, I will share with you the increase in the rents. So let's say over 10 years, you raise the rents from an average of $500 to $1,000 a month, okay? That's an extra $500 a month you've added to the income of the property. If you did a 50-50 split, you would keep 50% of the increased rents, and the seller would keep 50% of the increased rents up to the 10th year, or including the 10th year. And that's what he agreed to. And by the way, it did not include, it excluded the other 30% that were not rented, because I had to get those leased and rented. And whether he didn't recognize it, I have no idea, but he went for the deal. So all the other 30% of the vacancies that I filled myself, I didn't have to share those proceeds with him at all. Future rent increases or any of them. The only ones I had to share with him are the ones that were currently rented at the time. And I got the property pretty much close to half what he was asking for. So at the end of the day, he got a big pound up front. He got passive income for 10 years. I got the property I wanted. And of course, within the first year, I satisfied the 30% vacancy rate by renting those properties out. So I had a fully performing property that I got at a drastic discount over what I would have bought it for had it been fully rented. And I also got a portion of rent increases on all the other units that were previously rented. By the way, the reason I did that was they were grossly under rented. The rents that they were charging were grossly below what they should have been. Okay, so it was easier for me to raise the rents. In any case, great strategy, especially if you're looking to break into the rental market and move into some bigger properties. And vacancy rates are historically very low right now. They have been for some time. There's just not a lot of supply out there. I mean, there's a shortage of housing right now, at least in the United States. So until the builders catch up with the rentals, apartment complexes, a strategy like this could work very well, guys. Okay, all right. Let's make this the last one. Satisfying the seller's needs. It sounds kind of obvious, but really what you're doing is through an interview process, you determine what is it that the seller wants to do. If they just say, well, I just want to retire and go buy a boat and travel around the world, you figure out how you can get them around the world vacation, where maybe you get a wholesale and you make that part of the deal. So let's say you get them a vacation that's worth $20,000, but you're able to get the vacation paid for half of that. You can say, look, I got a $20,000 vacation here. I'll give this to you as part of the purchase price. And if it satisfies their needs and wants, they get what they want, you get what you want, and everybody wins. I've seen all kinds of crazy scenarios here. People wanting boats, people wanting classic cars, just all kinds of crazy stuff. Just find out what it is they want to do, all right, and help them do it and make that part of your transaction. Tell you, let me try to squeeze off, discounted bonds. This is a similar approach, similar to the notes. So let's say you own a couple of, doggone it, sorry, just did it again. Let's say you own some corporate bonds, right? Or maybe federal bonds, either Canadian or US bonds. And you bought them years ago. There's bonds out there that have been in existence for decades now, okay? And maybe they're paying premium. Maybe they're paying 5% right now or 8%, okay? What you can do is, you can sell those at a premium because they're paying a higher interest rate than what the prevailing rates are now. But let's say you have a bond that's paying less than what's being paid out now. You can discount that bond. You can say, look, I've got say Mr. and Mrs. Smith, whatever. You've got a $100,000 bond, okay? It's only paying 1%. I can get 3% right now. I can get a mortgage to pay 3%. I will buy the bond for you, but it's only going to be worth maybe 2/3 of what the face value of the bond is, based on the interest rates it's paying. So you discount the bond is what you do. And all these values, by the way, all these figures, guys, you can get from publications. You can go to the New York Stock Exchange, go to the Wall Street Journal and find out what bonds are paying right now, and see what other people are discounting them for. And that's, again, it's unique. It's only if somebody has bonds. You don't have to be yours. They can be someone else's. Okay. I think I'm going to wrap it up there. Well, this is kind of what we talked about earlier, using equity in one property to buy another, except in this case, you're not really getting a blanket mortgage. What you're doing is you're offering to the buy. Let's say you want to buy a property and you already own one where you have substantial equity. You go to the seller of the property you want to buy and you offer them an equity stake in the property you already have. Okay, because maybe you have a single family home and they're tied to the multi-units, and they want to focus on single-family homes, and you want to focus on multi-units, and they have a multi-unit. Okay, you can say, look, let's just do like a swap here on equity. I'll give you equity in my property in lieu of me making a down payment to you on your property. Okay. Again, really easy creative strategy. Wraparound mortgage. I tell you, let's go ahead and do this one, guys, and we'll wrap things up. This is different than a blanket mortgage. What this is you're offering the seller. Let's say they have a mortgage at around 150,000. I don't know. I'm not going to read the full example here. What you do is let's say the property's worth 500,000. Okay. We should probably just use the example. Okay. Let's say in the example, property's worth 250,000. The seller has an existing assumable mortgage for 150,000, 8% interest, payments of $1,270 a month. Okay. The seller's equity is $100,000. 250 minus 150 is $100,000. All right. Classic way to do it. This is a no money down technique. So what you do is you assume the first mortgage, right? The buyer would give the seller a second mortgage for 100,000 balance at a mutually agreeable interest rate, so say it's 10%. So now those payments are $1,000 a month. Okay. Purchaser's total payment will be $2,270. In other words, $1,000 plus $1,270 is what you, the buyer or purchaser, are giving out. You're paying out to the property. $1,270 on the mortgage payment because you assume the mortgage, and $1,000 a month here. Okay. If you want to avoid those costs, you could offer the seller a $250,000 wraparound mortgage payable at 10%. Okay, which means your payment's $2,225 a month. Okay, and your mortgage wraps around their mortgage, so they get essentially $100,000 that they wanted in equity, paid out over time. Okay, so if you look at the payments, $2,225 times 12 is $26,700 a year. The seller's annual payments are $14,700, right? Remember, $1,225 times 12. Okay, so the seller keeps the difference of $12,000 per year, right? $26,700 minus $14,700. Everybody with me so far? All right, equity is $100,000. So the seller is actually netting 12% under $100,000 equity. In other words, $12,000 a year divided by $100,000 is a 12% return. But it gets even better than that. Okay. The original first mortgage, let's say, is going to be paid off in 20 years. At the end of 20 years, your mortgage that you gave them still has a balance of $165,000. So they essentially turn $100,000 equity into $165,000, and they got 12% return on an annual basis. Win-win all the way around. In any case, I love that. I love that strategy. Everybody wins. You get the property, they get the property sold. And let's call it a day at that, because the next set is a whole bunch of federal, provincial, or state and local programs. So in any case, guys, a good subject for tonight. I appreciate all the questions that brought this to light. I will see you next week, by the way, on the 18th. And we got Louis Reset coming back on. He's going to go over some additional online tools and techniques to research people and properties. So stay tuned for that. That's next Wednesday, the 18th. In the meantime, God bless you and your families. Hope you have an awesome rest of the week and weekend. And we will see you next Wednesday on the 18th. Okay, guys, take care. God bless. And I will see you later. Bye-bye.